Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. An undergrad econ major, Cameron Dawson got hooked on markets early, taking a class on securities and portfolio analysis in business school, which set her down the path of market study. She broke into the business as an industrials analyst on the buy side, time that gave her an opportunity to develop an appreciation for how the macro landscape intersects with micro business fundamentals within a cyclical universe of stocks. In this context, we review the period from 2014 to 2016, a time of ebullience within the energy sector and a fracking supply boom. For Cameron, there are important lessons to be had in observing the speed with which this optimism gave way to a protracted down cycle by late 2014, and in sharp contrast, when the sector appeared uninvestable in early 2016, the stocks would turn, discounting the improving fundamentals that would only be visible by late 2016. Here, she sees lessons with how forward-looking the market can be, noting that if you weren't there early, you missed it. We talk about her role as Chief Investment Officer at NewEdge Wealth, a firm delivering wealth management solutions to high net worth investors, and I asked Cameron to reflect on how clients' needs are different now in a 5% short rate environment. Noting that, all else equal, higher rates argue for rebalancing away from equities, she highlights the importance of taxes, especially for investors with low basis stock. We also talk about stock-bond correlation and the implications for portfolio construction. Here, Cameron suggests that there is room for bonds to play a stabilizing role should the stock market run into trouble, especially in a disinflationary flagging growth scenario. Lastly, we review some of her recent work on reading the tea leaves of market prices. She notes the recent underperformance of high beta names versus the rest of the market as an early warning sign of flagging risk appetite. I hope you enjoy this episode of the Alpha Exchange, my conversation with Cameron Dawson. My guest today on the Alpha Exchange is Cameron Dawson. She is the Chief Investment Officer of NewEdge Wealth, an RIA delivering a range of investment services and retirement planning to its client base. Cameron, thanks for joining us on the podcast today.
Thank you so much for having me, Dean.
Well, we're taping this on a day where there's a little bit of reemergence of volatility in the equity market, seems linked to rates. A lot to talk about there. Let's get our conversation underway, learn a little bit more about you and your career history. Tell us just about how you got started in the business. What was your early days? And then we can take it into your time now at NewEdge.
Definitely. Well, it was one securities and portfolio management class that I took when I was in business school that absolutely hooked me. I went to Crummer, which is the business school at Rollins College, and a professor who said, this is the hardest class you're going to take in your entire MBA. And boy, was he right. I was immediately hooked. I'd been an economics major as an undergrad. And so kind of had the background of liking the study of business cycles and was fascinated by the study of economics. And then went into business school and found myself not necessarily engage completely with all the other sort of portions of the business school classes and said, what's the hardest class I could take? And somebody said this finance class. And for me, it was always like applied economics. And so I had the support from the school and that Professor Singleton, to help me in the process of breaking my way into the industry. I did that through the CFA program, starting and getting my CFA charter, and through the exams, through the scholarship program. That's actually how I got into Bank of America. One of the adjudicators of the scholarship for the local Orlando Society was a Bank of America portfolio manager for the U.S. Trust business, which is now their private bank. They say it takes a village, but I think this is the coolest industry from the aspect of that it always is changing. You never have mastery. It is always a challenge and confounding. And to me, it's like being in school every day. I love school. I love studying. And it is really exciting to get to be in the thick of it. And I feel like I'm probably one of the luckiest people in the world that I look back at my education, my college time, and my MBA, and say, here are all the things that I studied and I actually use them every day. I don't know if many people have that luxury, but it's pretty darn cool.
Yeah, that's great. My own start in the business was also linked to identifying very quickly that I enjoyed finance and economics. I like the way you frame finance as applied economics. You also hit on something else, which is this business is humbling. It's hard. It's always changing. You better really be humbled by the way in which these cycles can surprise you. Market prices can surprise you. I completely agree. Let's look back a little bit. I always like to just try to get to know a guest's framework a little bit through the experiences that they've had in markets. Someone once said, we are our experiences. And I think in markets, that's certainly the case. And so markets deal us all kinds of episodes of uncertainty and things that catch us off guard. I was hoping you could just look back. We'll talk a lot about the here and now, but if you could just look back on maybe some periods, some episodes, cycles that you found particularly interesting, maybe particularly challenging to try to discern what was happening and how those might have come to impact the framework you use to think about risk and opportunity.
I was a buy-side industrials analyst, and I always thought that being an industrials analyst was kind of like living in dog years, because you have a lot more cycles within an economic cycle than you do in other sectors, which tend to trend. So compared to being a tech analyst, where you, of course, are sensitive to the macroeconomic drivers, but there's a lot more idiosyncratic drivers. What I found in my industrials research is that you could do something like predict perfectly the number of excavators that Caterpillar was going to sell in a certain quarter. But if you didn't have the macro right, if you didn't have the understanding of what China was doing with its stimulus or what commodity prices were doing, you'd really get the stock wrong. And that a lot of these areas of the market that do tend to be more cyclical force you to rely a lot more on a macro top down than even a bottoms up. And that's really more for large caps than the smaller and mid caps, which do have more opportunity for more idiosyncratic drivers. But I remember going back to the period of 2014, 2015, and 2016, which were probably the most formative years of my time as an analyst, because of the different phases of the cycle that I learned compressed into just 3 years. So pretty much an entire market cycle. So 2014 was a year of euphoria. It was a year of fracking was going to save everything. I was going to conferences, and even railroad analysts were passing around vials of frac sand to show the promise of the US energy and oil boom. And this optimism very quickly devolved into a bit of a great crisis for the manufacturing economy as they become over-indexed to oil when oil prices cracked. And I remember it so vividly at the end of June, beginning of July of 2014, and just descended all the way down. And you had this period, I think it was Thanksgiving Day in 2014, where OPEC actually kept raising production and pushed oil prices lower and lower and lower. And what this created was a world where you had a massive inventory destocking cycle, because everybody thought that the boom was going to keep going and that you could continue to pay truck drivers $150,000 a year up in the Bakken and in North Dakota, and that bloom quickly fell off the rose when $30 oil prices became the risk or the reality. So 2015 was the rationalization process. And I remember going to my team going, guys, something's really bad happening in the global economy. You had China doing its rating of the yuan in the summer of 2015, and markets were just ugly, and learning that navigation of what names do really well in down cycles, what names don't do well in down cycles, where to hide out and where to find stability through a cycle. But then the last piece of it was 2016. And 2016 was when everybody finally came around to what was going on within the manufacturing economy. Journalists were saying, oh, yeah, it's a recession. And what's interesting is that, you had all these calls that the world was going to end. I vividly remember, and my old portfolio managers that I work with at US Trust remind me as well of this day. It was probably 2 days before the bottom in 2016, when we had analysts come in and just scare the living daylights out of all of the portfolio managers, because saying, look, everything's terrible. China's in free fall. Everybody's in free fall. We're never going to mine another ounce of copper ever again or drill another oil well. And that literally was the bottom tick. And that cognitive dissonance at bottoms, when everybody's sounding terrible. Companies are cutting guidance. Analysts are cutting their estimates. You're having all these warnings about dire economic predictions, and yet the stocks are ripping higher. And the lesson of that was that it just simply couldn't get worse. You could not press these things any lower. And once you've gone from 300 excavators a year down to 3 excavators a year, there's not much worse to go. It was such an important time for me to learn just how early and really respect the forward discounting mechanism of the market and this ability, this incredible ability for it to sniff out turns in the fundamentals. It took until the third, fourth quarter 2016 for the fundamentals to stabilize, not even to turn, for them to stabilize. But you had all that second derivative starting to improve and the stocks ripped higher. The last part of that is that if you weren't there, you missed it. If you weren't there in the early periods of that rip higher, the relative performance in the cyclical parts of the economy actually peaked by, I think it was like 2 weeks after the 2016 election. So many powerful lessons of when emotions can get in our way, when we can get stuck in our analysis about things being either too good or too bad, and to really just respect the charts. And it's one of the reasons why I believe so strongly in this idea of a multidisciplinary analysis, this idea of merging fundamentals, merging macro, merging technicals, all together, behavioral finance, and merging all of these things in order to create a clear picture of the economy and the market. Doesn't mean you're always going to be right, but it does, in hope, help you see around corners and keep you honest based on what either the market or the data is telling you.
It's a really interesting just review of what was a pretty fascinating time. You talk about using market prices to look around corners. So I think that's going to be a good topic of conversation for us. I know you've got a lot on your mind in terms of sniffing out what the market might be implying by way of different relationships. But I did want to go back to what you talked about in 2014, because a couple of things as you were discussing that came to my own mind, which is I look a lot at markets through the lens of vol. And I like to say there's a VIX for every asset class. The VIX has got all kinds of cousins. And our two real lows in the VIX are, let's call it the end of 2006 and the end of 2017. You're pressing below 10. But if you look at a cross-asset measure of implied vol and you include rates and you include commodities, specifically crude, your low in a blended basis is more like June of 2014. And what was so fascinating to me, and I'm not someone that spends a lot of time in the crude market, but you had implied volatility on options on crude at around 14. And that is just as low as you could imagine. I mean, I think that's sort of a VIX equivalent of maybe 7. The market was so stable. It was just stuck at 80. And it's so fascinating, this sort of dichotomy when the riskiest time in the market can almost be the time when the risk measure is the lowest. We could maybe argue the same thing for credit spreads circa 2006 as well. I like this comment you made about dissonance at the bottom. There's probably some dissonance at the top as well.
Well, certainly, because low volatility by definition breeds complacency. It allows, whether you're looking at it from a flow standpoint and market structure, and it allows for carry trades to proliferate. Those kinds of trades where you're selling a low yielding asset and buying a high yielding asset really only work in times of low volatility, but that builds on itself until it doesn't. It's that Minsky moment where you have low volatility and then a sudden spike of high volatility because of all of those bets for low volatility get unwound. You probably remember Volmageddon of 2018, where you had this period of very low volatility through 2017, and then all of a sudden this wake-up call. So I think you're right. We certainly had a period of low volatility this year as well in equity markets by the time we got to mid-late July.
You mentioned Minsky. One of my favorite quotes from him is, and I think this applies very much to carry trades, I think I'll get this right. He said, success breeds the disregard of the potential for failure. And I think when your carry trades are working so consistently, they get bigger, you tend to do them at thinner margins of error, and boom, something happens like a Volmageddon in 2018. So here's where I would like to take the conversation. I want to really talk about your views here and now. You've got some really great writing that you make available. That's a nice thing that you do, not just for your clients, but for others really trying to follow your thought process. So before we do that, I would love to just talk a little bit about the RIA business, your pivot into the RIA business first, and then we'll talk a little bit about NewEdge as a firm and what it's delivering to its client base. So talk to us about the pivot away from a buy-side industrials analyst into NewEdge.
There's firstly a great migration into the independent RIA channel out of traditional wealth management and wirehouse channels. Part of this really can be encapsulated in just one word, which is flexibility. And this ability to be able to either be flexible. I see it every day. I live it every day with the kind of technology that we're able to use and implement. We are smaller in size, which does work to our benefit. One of our head of platform always talks about how we sign 1-year contracts on things. So if something doesn't work, we're able to find new and exciting technology with the whole goal of driving better outcomes for clients. But then we also have the greater flexibility with how we approach what we can do. Instead of having to say no and be an exception business for our clients, which we focus on the high net worth and ultra high net worth channel, that set of clients have often been told no a lot. We can't do this. Compliance can be the tail that wags the dog, though, very important. So this flexibility, I think, is very exciting. We're also growing, and it's something that from an entrepreneurial standpoint, to be able to have an impact and grow an organization is really enthralling because it allows me to be far more involved versus just being very narrow. One of the things that I saw as well, kind of in the broader industry on the buy side, was the shrinking of your traditional buy side teams because of fee compression within the mutual fund industry and some of the big changes that were happening that resulted in a lot of my peers who were great analysts getting laid off. And I looked around and said, well, if these people are getting laid off, there has to be a better long-term career. If I'm an analyst, I can see these trends. And that's what led me into becoming much broader, focusing on things like market strategy. Again, the industrials lent themselves really well to that because the industrials are so macro sensitive. And I always loved the bigger picture. That was what really got my heart singing versus projecting out segment line discounted cash flow models. They're great, but I prefer thinking about things in the big picture. And so then that led me to looking for opportunities in market strategy. And then about a year and a half ago, I got this opportunity to join NewEdge. And it's been extraordinary because we are growing rapidly. And that's exciting from the first start. This ability to be able to have an impact and construct and design a business and make a decision and be able to change it immediately and not having to work through a whole bunch of layers. It's a really exciting thing to do. And I'm learning so very much because I'm not narrow anymore. I have to be a jack of all trades. And, it's a lot of work, but the learning experience and process is pretty darn cool.
Well, all parts of the financial industry are evolving, the buy side, the sell side, and certainly the RIA segment as well. Technology is a ever-driving force for compression, for portfolio allocation. I might call them competitors that do robo-advising. How would you just describe big picture, the trends in the industry that you're observing, and then where NewEdge fits in terms of delivering a unique product?
Yeah, I think for us specifically, what we saw was if you looked at the industry, you saw the high net worth and ultra high net worth segment of the market, not necessarily being underserved, but being in a position where the kinds of things that were open to them and offered to them, they had the opportunity to see a lot more. But the largest institutions were moving further towards the mass affluent channel, meaning that there was somewhat of a dilution in the kinds of opportunities and the kinds of strategies, as well as the kinds of customization and personal kind of approach to markets that this cohort really deserved a different and better experience. And that's what we set out to do at NewEdge, is saying that if we're laser focused on our core customer of being in that ultra high net worth and high net worth channel, would we do things differently? And the answer is yes. There are certain kinds of investments that we can do because of fund sizes, that we can do smaller funds because we don't hit the law of large numbers. We have this great integration with wealth strategy, which is incredibly in-depth processes of getting to know clients and their entire balance sheet, and then actually constructing portfolios around that with a lot of customization to it. It's that laser focus that has opened up this ability for us to say, here's where our competitive advantage is, because unlike other institutions, we do have the luxury of focusing just on this client set, which is, I think what makes this very exciting and very differentiated in the marketplace.
Well, we talked about the period from 2014 to 2016, and there were some fractures in the global economy. As you mentioned, China was all the discussion, people worried about spiraling lower of the currency and global impact there. But one thing where there wasn't really a lot of vol at all was rates. The Fed was still reasonably dug in on forward guidance. The MOVE index was quite low. And here we are in a 5+% short rate and a 4.5% 10-year. Just a incredibly different setup in terms of the cost of doing nothing, the cost of staying home and just putting your money into a treasury. And I was just hoping you could kick off our discussion on the here and now by reflecting on that impact with regard to how you interact with your clients. What do the demands look like, or the asks look like from the client base in a 5% risk-free world now?
It is such an important question, because if you think about the last 15 years and you go back to the origin of quantitative easing, one of the key aspects of QE, or key purposes of QE, was to lower long-term interest rates in order to reduce the return potential of risk-free assets, in order to force people out the risk curve so that they had to take more risk, provide more support under riskier assets, which of course the Fed was afraid that you would have this deflationary bust where people didn't want to take risk because of what happened during the great financial crisis. So this pushing out of the risk curve would then have the dual impact of being able to boost the wealth effect, meaning that as stocks went up and housing prices started to recover and credit spreads started to come back in, that you would see businesses be able to invest more, and you would be able to see people feel better and spend more. And of course, you go back to just how skewed the benefits of QE were to different income cohorts, with the highest income parts of the economy being those with the ability to benefit from it the most because they had the most equity and risk asset exposure. But if we think about this, then this idea of QE pushes you out the risk curve. Your question is, does QT, higher interest rates caused by QT, or unwinding of the Fed's balance sheet, pull you back in on the risk curve? Meaning that if your goals stay the same, meaning I want to earn X percentage of a return on an annual basis in order to be confident I can retire in this many years or meet this goal, then if you can do that with less risk, should you? Meaning that could you reallocate to fixed income, for example, out of equities when you have higher yields that you can lock in? Now, of course, you're not locking in high cash yields simply because if interest rates fall, when and if they do fall, you'll see that roll issue as you roll into lower interest rates. However, we discuss this frequently when we look at our strategic and tactical allocation process, because for years, our cash line was at 2.5%, and yet cash didn't yield 2.5%. And when clients and advisors would be like, what is going on? Why can't we have something more accurate? And now we're yielding at 5%, but our cash line in our capital market assumptions is still 2.5%. The thinking behind that is that's the Fed's long run neutral rate. So it makes sense for a 10, 20-year projection of capital returns to keep it at that level, even though that may not be what you're experiencing today. But then it raises the question, should you rebalance portfolios in this brave new world? And should you sell risk assets and buy less risky assets because you can earn the same return with less risk? The question that raises is, of course, what's your tax basis? Our clients are the most tax sensitive clients, given they typically will pay the highest marginal income tax rate. And if you've been invested for a while, you have big, huge capital gains. And so if we're talking about a percentage or two difference in capital market assumptions kind of going forward, we have to be very, very careful about just ripping out of risky assets like equities, because we'll take a haircut on the realization of those capital gains taxes. So we always keep that in mind in building portfolios. At the same time, is that I think we have to ask, how much of higher yields today do we really want to extrapolate going forward into the future in the long run? I think the last part of this is that I will make the argument that I think that forward returns in equities will be lower in the next decade than they were in the prior decade. In the prior decade, the setup was extraordinary. Not only did you have incredible Fed support, but you also had equity valuations that were near multi-generational lows coming out of the great financial crisis. You had equity allocations at incredible lows, the lowest you had seen, of course, since the depths of the tech bubble, which just means that people had given up on stocks and weren't allocated there. When you combine the two things of cheap valuations and nobody's there, that is a very low bar to jump over, and it creates this benefit of everybody having to climb the wall of worry. And I think it's why we were set up to be able to have equity returns over the prior 10 years at pretty much double the long run average. They annualized at about 14%. Long run average is 8-9%, depending on which window you look at. So if we look at then today and see the setup, what you see is valuations are high by any historical standard. They've only ever been higher for the S&P during the COVID bubble and the tech bubble, and of course, all the way back to the pre-Great Depression era. So valuations being very high. And yes, we have seen equity allocations come off some from their peak in early 2022, but they're still relatively elevated. You put numbers around it, I think we're sitting at about 65% allocation to equities versus a low in the great financial crisis of closer to 40-45%. If you're looking at the AAII data. Don't quote me on that. I don't have the chart in front of me, but it still is well above the setup that we had coming out of the great financial crisis. So just because equity returns are going to be lower, it doesn't necessarily mean that you should invest in equities less. Of course, you have to compare it to what your other options are. But I would argue that if equity returns are lower, it likely means that other alternative assets returns are going to be lower as well. So your private equities, private credits, venture capital parts of the world, as everything is interrelated. I think the last point to make, though, is that this is where, if we are in a lower return world, the shift comes to where it's not just about the index level returns, it's what you keep at the end of the day. And that's where having a great deal of tax consciousness and wealth strategy becomes incredibly important. Fee consciousness is important. And so it's really about making sure that if you are going to be in a lower return world, that you see it for what it is. You still need to be invested. Doesn't mean that you should sit and hide out in cash, but you have to be far more conscious about what you keep at the end of the day.
We're sitting here, and at least over the last 3 months, the correlation between, I'll just use two basic proxies between stocks and bonds, the S&P and TLT is positive 36%. So this is not the stuff that diversification dreams are made of. That's on the incredibly high side, probably in the 95th to 100th percentile. What do you make of that? Is the return of risk on, risk off, where you could feel comfortable that the bond market owning duration can play a stabilizing role? Is that behind us? Do you see that returning at all? How does that fit into your calculus in portfolio construction?
I was thinking about this question today when I heard Tom Keene ask one of the people he was interviewing is 60-40 dead. And he's asked me that question as well. And I don't think that after a big reset in rates that now would be the time to completely give up on fixed income. And what I mean by that is that the degree of losses and the positive correlation with stocks in fixed income really is a function of just how mispriced these assets were because of the degree of intervention we had by the Fed. And given the size of the balance sheet, and that I think it's also one of the reasons why the yield curve has been such a poor leading indicator this cycle, meaning that we've actually been in one of the longest ever periods of inversion of the 3-month 10-year. I think it's past 10 months, or it's much past 10 months now. I think that speaks to the degree of intervention we had, the removal of that intervention, and now we're getting to the point where yields are starting to look more priced to where they should be. So if you were to choose a time to give up on an asset class, once you've gotten back to a more realistic level of valuation, now would not be the time. And I think that we're closer to the point where if we see a recession, bonds can play that role that they have in portfolios in the past of being a stabilizer. Now, of course, all of this depends on if we have a classic recession, which usually involves disinflation, or if we have a stagflationary recession where bonds would do very poorly in that scenario. If we're thinking about the construct then, or the backdrop of how that scenario would play out, to have a stagflationary kind of recession, what you do need to see is an exogenous shock of things that are not driven by the level of demand. So really a supply side crunch that drives inflation higher despite what demand is doing. That would have to come from something on the oil side or the food side, like what we had in the 70s. Of course, you had the added add-on to that of the structure of the labor market, given the percentage of people in unions, which added to these wage price spirals and allowed that even when you saw the economy weaken, you still kept a high rate of inflation because of the exogenous shocks and the ability for those exogenous shocks to immediately be put through wages and that kind of building on itself. So what I'd say is that as long as your base case is not a big stagflationary kind of recession, even in that scenario with stagflation, yields, we think that you can still get close to about flattish performance because of the higher yields we have today. The reason why it was so painful back the couple of years is because you weren't making anything on the yield, so you couldn't absorb any losses. Now, that doesn't mean that we're out there backing up the truck on a bunch of super long duration assets yet. We don't see the whites of the eyes in deteriorating data from an economic standpoint. We're starting to see signs of things of weakness. There's things that catch our eye that certainly puts us on alert that maybe this period of stronger growth could be starting to fade, but we're not seeing enough evidence yet that would say shift all your short duration into long duration. We, of course, don't want to be too cute with the timing. I get that. We always are investing for the long run. But I think that our base case going into this year was that the return from fixed income would be driven primarily by the coupon, meaning the yield that you get. It wasn't going to be driven by price appreciation simply because we didn't have the drivers for substantially lower yields unless we had a recession. If we have a recession, I think bonds can then play that ballast in a portfolio, which means bringing it back that if there's a time to give up on bonds, it wouldn't be once they've already normalized and repriced to more realistic levels.
Well, let's dive into a little bit more of your current views. So you've got this note out, Dance of the Clairvoyants, Pearl Jam song. So near and dear to my heart, that band.
Yeah, but it was a new Pearl Jam song. I much prefer the old stuff.
Yes, very new, very new. I was thinking about another song, Dancing in the Dark by Bruce Springsteen, and that takes us back to 1984. Maybe that's more akin to the Fed at this point.
I saw him twice. I saw him at MSG in Brooklyn at the Barclays Center. So believe me, I'm a big Bruce fan.
Some would say the Fed might be dancing in the dark right now.
Yeah.
The thrust of this note is around the read-through of market prices. I love studying market prices. Obviously, they're wrong all the time, but there's a lot to be gleaned in terms of the study of different relationships on an absolute basis, relative basis. And so you've got a couple of things here I'd love for you to talk a little bit more about. First is just around risk appetite. You cite the relationship between high beta stocks and the S&P as one segment of a read-through on fading risk appetite. I'd love for you to talk a little bit more about that first.
This idea, I'll start with sort of just a definitional, is that this is a portion of intermarket analysis, which itself is a portion of technical analysis. And it's meant to glean about when you look at market leadership, what is that telling you either about risk appetite or growth expectations within the economy or for earnings estimates? So it's not necessarily trying to say, oh, buy this sector today and make more money by doing sector rotation. It's trying to take out messages of saying, hey, is there a reason why certain names are outperforming or underperforming based on what's going on in the economy or the liquidity backdrop? So the one you mentioned is high beta. And what you see with high beta names are those names that go up more when the market goes up and they go down more when the market goes down. And these names, beta capturing this higher volatility, tend to do really well coming out of major market lows and in risk on periods in the market. Part of this is because they tend to be riskier stocks, but they also benefit from the liquidity boost that you often see coming out of market lows and liquidity boosts that you see at different times of the market cycle. And so what we saw this year was a big outperformance of higher beta parts of the market at the beginning of the year, and then really got a boost again in March, given the added liquidity post the regional bank issues. And high beta stocks then started to stumble. And then they tried to make a new high. They did on an absolute basis, but they didn't make a new high on a relative basis. And that was a really important divergence for us. That divergence meant that even the names that were supposed to be going up more than the market weren't going up more than the market. And that was telling you that risk appetite was starting to fade. We saw this same kind of divergence in 2021, where the highest beta, you think of like your speculative tech and all these names that retail traders were piling into, these high beta names hit a new absolute high at the end of 2021. Didn't make a new relative high, though. And the end result was that actually preceded a big drawdown, not just in the high beta names, but within the rest of the market. So it's sort of this idea of the tip of the spear of risk taking. We like to see for the market to really sustain moves higher, risk appetite to be healthy and for people to want to have increasing exposure to risk. And when you start to see that start to flag, it can be an early sign that broader risk appetite is starting to recede or that liquidity is starting to recede, because that's the other part of this, is that high beta tends to do really well when liquidity is a tailwind.
Let's also talk about another segment of this note, which is around real incomes and the impact of inflation. So we had both rising substantially and both are past their peak. Incomes are still growing at a healthy level, but down from where they were. Maybe that's good news in terms of how the Fed thinks about things. Inflation, well off its peak on a year-over-year basis. It's come down quite a bit, but there's certain signs that you might be worried about, one of which might be energy. Talk to us about how you think about real incomes and maybe the tailwind of real income growth and how you think about how that interacts with consumer spending.
Real incomes have been sort of a sneaky surprise tailwind for consumers sort of at the margin over the past few months. And that was the real headwind for the consumer over the last couple of years. It's interesting. You can go back to 2021 to see real income growth or real wage growth turning negative back in April of 2021, meaning that, yes, wages were growing, but consumers were losing purchasing power and they started to feel awful. They started to feel terrible. That's when you saw the big breakdown in the University of Michigan Consumer Confidence Survey. And the interesting paradigm in this, though, is that despite how bad consumers were feeling and they were at recessionary lows by the time we got to 2022 in June, when you saw that peak oil price and kind of peak destruction of real wage growth, the most negative you got to, because that was the peak in inflation, but that they still continued to spend throughout all of that. And they pulled back on certain areas. You saw goods spending pull in some, but services remained really strong. And I think part of this is because they had tailwinds, other tailwinds than just income, whether it was things like continued support from certain stimulus measures. You had some child tax credits that existed through 2021. And of course, the incremental stimulus that came in the beginning of 21, which boosted savings. And that savings still had the ability to be whittled down further and further over the course of the past couple of years, and now have just gotten to the point where they're pretty much gone. So we've lost that as a tailwind at the same time as you had consumers returning to credit card spending after paying down a lot of credit cards during the pandemic and not utilizing them. What you had was credit card debt, revolving debt as a percentage of consumers' disposable income reach multi-decade lows during the pandemic. And so even though that has started to move up, consumers from a revolving credit basis aren't nearly as stretched as they were in prior cycles. If you think going back to 2005, for example, when consumer credit was far more stretched. So there's been room for consumers to add on more credit card debt in order to supplement their spending, even in a period where real wage growth was negative. Now, since June of last year, real wage growth started to begin to recover as inflation started to moderate, and that's provided an important tailwind for consumers to spend in other areas. But then it's a question of, does that recovery and real wage growth continue if we start to see a reacceleration in inflation, mostly energy cost inflation? Of course, energy costs are top of mind for consumers. We can see the University of Michigan expectations for inflation is highly correlated on both a 1 and 5 year basis to gasoline prices. But as we see energy start to creep up, the level to watch is when energy spending as a percentage of wages gets above 5%. That's when consumers really start to feel the pinch. The last data clip that we have is as of June, so it doesn't capture the recent move in energy, and that was about 3.5%. So we'll continue to watch that closely. For other context, it got as high as 8% during the 1970s, when obviously energy costs were terrible and you had gas lines, and it was a much bigger portion of consumer spending. It was a more energy intensive economy. So when we think about the path forward for the consumer, to kind of put it into a summary, we go, look, we've had a lot of tailwinds. Better real wage growth, lack of student loan repayments, you had stimulus support, you had excess savings, and the ability to be able to draw more credit card debt. Pretty much all of those things have now or are starting to reverse, really, except for the credit card debt. We're starting to see more delinquencies, but if you look at debt as a percentage of disposable income, it's just kind of back to pre-pandemic levels, means it could get worse. Not that you want it to get worse, it actually is destabilizing for it to get much worse. But you probably could see people rely on that a little bit more. But we're losing the tailwind from real wage growth. If inflation continues to move higher, we've already lost the benefit from student loan repayment, and savings have now been whittled down. And I think the last thing I'd say on that front is take the data with a grain of salt on savings balances. When you hear from banks that say, oh, well, money market balances or cash balances that our clients have are 20% higher than they were prior to the pandemic. Yeah, well, the price index is 20% higher, meaning that your real cash balance is no different, no better. So I think that overall, there's fewer tailwinds that the consumer has today, which raises a question if they can continue to be this really strong source of upside surprises to the U.S. economy, which of course it's 70% of the U.S. economy. So it's pretty darn important.
Well, markets move around for a lot of reasons. Sometimes confidence gets dented. There's a risk off that might be a function of, as you referenced earlier in the discussion, a product runs amok like the XIV in 2018. That's not really a real economy thing. But ultimately, the brightest line we can probably draw between indices like the S&P 500 and its performance is probably linked to earnings. The discussion in 2023 has very much been about, well, the recession doesn't look like it's coming yet. The growth metrics have kind of borne that out. So things have gotten pushed out. But you've done some writing on earnings, specifically highlighting the concentration. You called it the Magnificent Seven. Before, we know these beastly stocks like Apple and Microsoft and Tesla and NVIDIA. I'd love to just get your thoughts on the cap weighting of these indices, very, very top heavy, and how the earnings concentration, what that has meant for the behavior of the indexes in 2023, and then what you think it means for next year.
It's easy to look at the surface level of earnings estimates and be emboldened that everything's getting better. You look at the NASDAQ, and earnings estimates over the last 2 months for 23 and 24 are up 9%. That's pretty impressive. And no wonder the NASDAQ is doing so well. And no wonder stocks are up so much, because earnings estimates need to go up. The problem is with that is that if you look one layer lower and you look at the individual stocks, what you see is that it truly is 3 stocks. And it's nothing more. It's not even the Magnificent Seven. It's just three of them. It's Amazon, it's Meta, and it's Nvidia that have had big earnings estimate revisions higher. And even the rest of the Magnificent Seven have not seen those estimates revised higher. So Microsoft, Google, Apple, they're not seeing their estimates go much higher at all. And even some have had their estimates cut over the last couple of months. Now, earnings are always a lagging indicator, but it speaks to this need to be able to look under the surface to really get a sense of the health of the upside to the market. Because we would really like to see in a stronger economy a lot more names than just three driving earnings estimate upsides. And maybe this speaks to the fact that when we went into this year and we looked at earnings estimates and people said, oh, everybody's pricing in recession. We're like, no, this isn't pricing in recession. This is pricing in some normalization of margins, but certainly not a recession. Now, maybe the valuation was capturing some recession fears, which is why I was able to expand so much. But earnings have been pretty well calibrated all year long. And this drift higher recently has been driven by just that handful of names. And even if you look at the equal weight NASDAQ 100, those earnings estimates have been flat for the last 2 months, like not moved at all. I think going forward, we would really like to see earnings estimates move higher for a broader portion of the market if this is an economy that remains stronger than expected. But then you roll forward to 2024, you have another high bar. If you look at consensus for the S&P, it's up 12% for 2024 to about $245 a share. And so it always gets you to that point of, has all the good news been priced in? And what would it take in a backdrop to be able to price in even more good news? What would have to change for me to raise my estimates even further than where they are today? And then let's compare this to what the multiple is implying about room for those estimates to go higher. And that's why we look at the pricing in July, at the end of July, and went, we probably hit a valuation ceiling. Doesn't mean that earnings can't come save the day, meaning that earnings estimates could be revised higher as we go through the 3Q earnings season, et cetera. But valuations, we're pricing in a really rosy scenario on optimism about growth, but also a rosy scenario of support from the Fed. This idea that the Fed could cut interest rates and boost the market and liquidity, even if growth remains strong, which high earnings plus high valuation is simply saying Fed's cutting with strong growth. That's what the Fed pushed back on last week. That was the primary takeaway from last week's FOMC meeting. It was, hey, if inflation comes down, but growth stays high, maybe we won't cut rates, because if we cut rates, then inflation could come back. And that's been our core thesis, is that the Fed is not going to cut interest rates until it has a darn good reason to do so, which just means that when you were trading at 20 times forward in the S&P or 33 times forward on the NASDAQ back to its 2021 peak, you probably were pricing in a scenario from the Fed that was far more accommodative. So again, earnings can help. Earnings being revised higher certainly do help, but we'd like to see broader participation more than just three stocks.
Last quick question to round us out. As we talk about the Fed, there's always reference to this long and variable lags question. Where do you think we are? How much of the impact of these higher rates do you think has made its way into the economy so far? We've had accidents like SVB back in March. How do you see this evolving? Has the economic slowdown, is it reflected in these higher rates, or is there a lot more to come from your perspective?
I think that we need a different discussion about long and variable lags. You hear from the Fed, and Powell even walked through the impact of higher rates on the economy at the Jackson Hole meeting. You've seen former Fed presidents and current Fed presidents talk about, hey, well, maybe they're actually shorter this time around, because look how quickly markets reacted to the expectation we were going to raise rates. Look what happened in the housing market. Things slowed down, even though interest rates weren't that high yet. The IPO market shut down. You had speculative assets start to implode. You saw the implosions of crypto in early 2022. And then, of course, you saw kind of weak links in different balance sheets in the regional banking sector, which had a bit of a different flavor to it. But they'll argue that, oh, well, through the expectations channel, the lags are actually shorter. But there's another channel that I think is very important. And by saying that the lags are shorter, ignores the potential or the real economy portion of interest rates. We've written a lot about how the period of quantitative easing allowed investors or allowed corporations and consumers to term out their debt. Something we talked about at the beginning of the year is one of the key reasons that we didn't think we were going to have an imminent recession in 2023 in the first half was just that higher interest rates clearly weren't biting. They were slowing down new activity on things like housing, but you weren't seeing the dynamic of people getting priced out of their existing mortgages because the majority of people had fixed rate mortgages. And not just the majority, the vast majority, 95% of mortgages at the beginning of 2022 were fixed rate. You compare that to 65% of mortgages at the beginning of 2005 being fixed rate. What you can see is obviously a very different setup for the consumer balance sheet. The corporate balance sheet had a similar setup. The uses of commercial paper is far lower than it was in prior cycles. So floating rate short-term debt was far lower. And what you saw was big, huge issuance in 2020 and 2021, where corporations termed out their debt because interest rates were so low, effectively immunizing some portion of their balance sheet to these higher interest rates. Now, the thing about all of this is that eventually you have to refinance your debt. Eventually, there will be a real impact to these higher interest rates. And I think we're starting to see some of that aspect now. You can actually look at Census Bureau data and see construction for offices. I think I'm going to write about this week or maybe next week. And what you see is that office construction data in this Census Bureau is actually still near highs. And you go, how is that possible? Office is supposed to be in free fall because of interest rates and all this stuff. And the reality is that if you had a project in the ground, you're going to complete it. As long as you have the financing locked in, you're likely going to complete it because new offices are getting leased better than old offices. However, what we're starting to see signs of is fewer new projects, fewer new things added to the pipeline. And that shows you that the cost of capital is not conducive to making incremental investments. That's just one aspect of finally you're starting to see a real economy kind of pinch to activity. It eventually will work its way through the economy, but because of the dynamic of QE, I would argue that the real economy lags are even longer and even more variable. So I'll agree, the expectations channel, shorter, less variable, immediate direct. We've been in a purgatory sort of in-between period where growth has been stronger because of this dynamic of terming out debt. I think the question is, when do we enter the period of the real economy, longer, more variable lags that would actually show a real slowdown in the economy? So to answer your question briefly, I think that the real impact is to come. It's just always been a matter of timing, and the timing has simply taken longer this cycle because of the long tail of unprecedented quantitative easing coming out of the great financial crisis.
Well, as I said, Springsteen's Dancing in the Dark is going to turn 40 in 2024. So it'll be interesting to sort of set that against a Fed, which may not be seeing what folks like you are seeing.
Break out those jeans and cut off t-shirts. We'll be dancing.
There you go. It's been a great conversation. Really appreciate you being a guest, and thanks so much for the insights.
Thank you so much, Dean. It was a thrill. Thank you.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.